And the debt and deficit concerns are very much on my next guest's radar as well. Although she says the perfect week we just had in stocks doesn't normally happen in bear markets. Joining me now for more is Ann Sonders. She's the chief investment strategist at Charles Schwab. Ann, we're at session low. I mean, the S&P is down 0.2%, but clearly they don't like this continued upward march of yields on the long end. Welcome.
Nice to see you, Kelly. Yeah, I do think to some degree that the bond market is in the driver's seat for the equity market, and it's not really just about level, some threshold, above which the 10-year hits, and then it causes trouble for the equity market. But it's the why and the speed too. If yields were moving up because the growth trajectory were improving, I think the equity market would be fine. But it's the broader concerns about the debt and deficit and the ability to finance that and the budget wrangling that I think coupled with just the what of that breakout above 4.5% again on the 10-year that is not sitting well with equities, especially after such a strong run.
Right. So we have these two kind of warring data points. On the one hand, what we're seeing play out this afternoon kind of points you in one direction, feel a little uncomfortable about it. On the other hand, like you said, we had a perfect week last week where stocks were up all 5 days in a row. And that doesn't usually happen in a bear market.
It doesn't usually happen in the bear market, and you do have momentum on the side of the bulls here. I think the pain trade is probably still higher, but there's many statistics that have never happened before until they do. So, yes, historically, having 5 up days in a row has not happened during bear markets. It's happened during severe corrections. And of course, if you want to be pure to the simplistic, down 20% bear market on a closing basis, then we never actually hit a bear market for the S&P 500. So, we can play around with the definitions here, and history can only provide a bit of guidance given just how unique the combined set of circumstances are in this backdrop, both driving the equity market and the fixed income side of things.
So do you think 458, let's just call it on the 10-year, is a problem for stocks?
Again, it's not so much the level that matters. I think it's the why. If this was driven by the growth trajectory, I think things would be great. But the fact that it is still driven by uncertainty with regard to inflation, what the reaction function is on the part of the Fed as a result of that, and to Rick's point, just the wattage has been turned up on the spotlight aiming at the debt and deficit. And, on this subject, it's an interesting one because I talk to clients all the time, and there is not a client event I do where I don't get asked multiple questions about the debt and deficit. And this goes back years. So I think the investor class cares deeply about this issue. I think the average voter, because they can't really even conceptualize what $30+ trillion in debt means, and they don't tend to vote based on it. The higher wattage of a spotlight on this, I think all else equal, is a good thing. It does force attention on this issue that at least the investor class has known is unsustainable in terms of the trajectory. What ultimately happens as a result of that is hard to say, but I think you do have to plug it in as a volatility driver, not to mention the fact that I also agree with Rick in the sense that we don't anticipate fire sales of things like treasuries by foreign entities. But just think about the idea of losing some of that price insensitivity on the buying side, which comes as a result of us running trade deficits and the capital account surplus and dollars flowing out into the world. If you lose some of that buyer that is price insensitive, does that by default mean the price-sensitive buyer now wields a little bit more power? And I think that has feeders into the equity market, too, and may help to explain some of the mechanics of what's going on a day like today.